As the United States hurtles towards another consequential presidential election, a growing sense of unease hangs over the financial world. Investors, already grappling with the maddening puzzle of Federal Reserve interest rate machinations, now find themselves confronted with a new and perhaps even more vexing quandary, the specter of a ballooning national debt that threatens to engulf the very foundations of the global financial system. In conversations with money managers, Wall Street executives, and economic policy experts, a picture emerges of a nation careening towards an uncertain fiscal future, with neither major political party seeming to possess the courage or conviction to chart a sustainable path forward. The implications, both for the U.S. government bond market, that $27 trillion bedrock upon which the international financial architecture rests, and for the broader global economy, are far-reaching and potentially perilous. "It's the elephant in the room that everyone sees but no one wants to talk about," confided one veteran bond fund manager, his brow furrowed with apprehension. "We're staring down the barrel of trillion-dollar deficits as far as the eye can see, and it feels like policymakers on both sides are just whistling past the graveyard." Indeed, a close examination of the fiscal platforms put forth by President Joe Biden and his Republican challenger Donald Trump reveals a striking lack of urgency around the deficit issue. While the campaigns furiously trade barbs on a host of hot-button topics, from abortion rights to immigration reform, scarcely a word is spoken about the profligate state of the nation's finances. When pressed, representatives from both camps insist their side is committed to restoring fiscal sanity. Biden's team points to the over $1 trillion in deficit reduction measures the president has signed into law, and promises another $3 trillion in savings to come. Not to be outdone, Trump's spokeswoman vows the former president's pro-growth, anti-inflation agenda will magically shrink deficits and lower long-term debt levels. But for the sober analysts crunching the cold, hard numbers, such assurances ring increasingly hollow. The impartial scorekeeper of these matters, the Congressional Budget Office, recently unfurled a chilling projection, one where the federal debt mushrooms by an astonishing $21 trillion over the next decade, nearly doubling to $48 trillion by 2034. That would bring America's debt-to-GDP ratio, a key measure of a nation's fiscal health, to heights not seen since the immediate aftermath of World War II. Even more worrisome, these debt projections are likely conservative, premised on a relatively benign economic backdrop, sans recession, major wars, or other black swan events. A single major speed bump could send the deficit spiraling to truly unfathomable depths. "The current political calculus just doesn't compute," lamented Maya McGuinness, president of the Bipartisan Committee for a Responsible Federal Budget. Both parties seem to have tacitly agreed that grappling with the debt is a political loser. So rather than level with the American people about the difficult choices and shared sacrifices ahead, they just pretend the problem doesn't exist. As grim as the debt trajectory appears, it would perhaps be less concerning if the U.S. bond market gave indications of being able to seamlessly absorb a never-ending profusion of Treasury supply. But increasingly, signs are emerging that the creditworthiness of the world's largest economy can no longer be taken for granted. In a development that would have seemed unthinkable even a decade ago, the so-called bond vigilantes, those investors who punish spendthrift governments by dumping their bonds, have begun to resurface, pushing 10-year Treasury yields above 5% last year for the first time since 2007. While those rates have since retreated, thanks in part to the Treasury de-escalating the pace of auction size increases, most view it as merely a temporary reprieve. Looking ahead, the supply-demand imbalance in the Treasury market appears poised to only worsen. Larger auctions for long-dated bonds are seen as inevitable starting next year. Meanwhile, some of the erstwhile reliable sources of demand for Treasuries are starting to wilt. Foreign investors, for years the steadfast buyers of U.S. government paper, are no longer keeping pace with the market's breakneck growth. Whether due to economic challenges in their own countries, or increasing wariness over America's fiscal trajectory, their share of the Treasury pie is steadily shrinking. Then there is the Federal Reserve, that ultimate backstop buyer, which amassed trillions in treasuries via quantitative easing in the years after the financial crisis. However, its balance sheet is now headed in the opposite direction. As the Fed continues to methodically wind down its gargantuan stockpile of bonds as part of its fight against inflation, yet another pillar of Treasury demand is slowly being chiseled away. "It's a slow-motion train wreck," said one macro hedge fund manager, requesting anonymity to speak candidly. "Governments running huge deficits is nothing new, but what's different this time is the Fed is no longer enabling it by hoovering up all the excess supply. The training wheels are off, and we're about to find out just how wobbly the bike really is." These mounting anxieties have begun to percolate through the investment world, with some of the largest asset managers starting to adjust their treasury exposures accordingly. Rather than extend duration into an uncertain long-term future, many are hunkering down in shorter-dated government paper, hoping to sidestep the potential carnage in the longer end. Portfolio managers like Ella Haja of Newton Investment Management have already positioned for this brave new world of diminished treasury demand. With 10-year yields still at a relatively benign 4.4%, Haja is favoring shorter-term bonds, and warns longer-term yields could spike to 8 to 10% within a few years if deficit dynamics continue to deteriorate. Longer term, it's not sustainable, she cautions. Despite these growing tremors of unease, it's important to note the U.S. Treasury market is not on the precipice of some imminent implosion or crippling crisis of confidence. The greenback still commanding status as the world's reserve currency, coupled with Treasury's unparalleled depth and liquidity, ensure a sudden buyer's strike remains for now an extremely low probability, if not unthinkable, prospect. But even if a full-blown bond market revolt is not yet at hand, it would be a grave mistake to interpret the current relative calm as evidence of infinite investor patience. Like a quietly smoldering volcano, pressures continue to build under the surface. More discerning investors are beginning to demand greater compensation for ponying up at Uncle Sam's debt auctions. 10-year Treasury term premiums, that extra yield cushion buyers require for locking up their money longer term, briefly poked back into positive territory last month after years in the red. Over the past year, a worrying pattern has emerged whereby 10-year auctions more frequently require investors to be enticed with sweeter pricing than in years past, another subtle sign of receding demand. Look at history. There eventually comes a point where even the most indulgent creditors start to balk at lending to a profligate sovereign, noted the macro fund manager. No one knows exactly when that point arrives, it's more art than science. But by the time it's obvious, it's usually too late. So what, if anything, can be done to defuse this slowly ticking fiscal time bomb? Ultimately, the onus falls on our elected leaders to have an honest conversation with the American people about reining in the nation's unsustainable debt trajectory. But given the current polarized political climate, the prospects for a proactive, bipartisan accord appear vanishingly slim. Neither party seems eager to be the adult in the room willing to make the first move on contentious choices like entitlement reform, defense spending cuts or tax hikes. The answer is reducing spending, and neither side wants to do that, said Catherine Rooney Vera, chief market strategist at StoneX, who herself is positioning for a steeper yield curve in anticipation of surging long-term Treasury supply pressuring prices. Politically, one can understand the reticence. Proposing painful fiscal medicine to a voting public already skeptical of both parties is the political equivalent of handing your opponent a cudgel to bludgeon you with. Absent a market revolt forcing their hand, it appears Washington's fiscal can-kicking exercise is here for an extended engagement. But the irony is, the longer corrective action is deferred, the more wrenching the eventual adjustment will likely be. Like a patient who forgoes seeing the doctor for a nagging cough only to later get diagnosed with advanced cancer, a country that postpones fiscal consolidation heightens the risk of a future debt crisis that could make today's challenges look tame by comparison. For investors, this unsteady equilibrium of short-term calm, juxtaposed against metastasizing long-term risks, creates a formidable allocation challenge. Few asset managers appear eager to abandon treasuries entirely, given their still singular role as a liquid, perceived safe haven. But more are starting to rethink their exposures, especially in the longer duration bucket most vulnerable to diminishing future demand. Ahead of the elections, you probably don't want to be owning as much very long-dated U.S. Treasuries, said Bridge Karana, a fixed-income portfolio manager at Wellington Management. His sentiments were echoed by Craig Ellinger, head of America's fixed income at UBS Asset Management, who sees short-term debt as the safer place to be in case deficits do get out of control. Some institutional investors are going further, exploring more creative solutions for a world where treasuries may no longer be the port in the storm they once were. The head of investments at one multi-billion-dollar family office described how he's contemplating using equity index put options as a partial substitute for his portfolio's long-term treasury holdings. The puts would offer downside market protection without being as vulnerable to the vagaries of erratic future fiscal policy. Others still are looking to gold as a more enduring long-term store of value if confidence in the dollar becomes compromised. We've been gradually shifting a portion of what used to be allocated to treasuries into physical bullion, confided the manager of a large sovereign wealth fund. At least with gold, you don't have to worry about the soundness of the issuer when you hold it in your vault. If nothing else, today's backdrop of swelling deficits coinciding with the Fed's quantitative tightening serves as a stark reminder that the creditworthiness of even the mightiest sovereign is not something to be taken for granted. For years, investors could sleepwalk into treasury auctions, confident that the government's good housekeeping seal of approval and the Fed's invisible bid would keep them insulated from harm. No longer. With the Fed's balance sheet now moving in reverse, the marginal buyer of treasuries must cast a far more discerning eye towards Washington's future borrowing proclivities. In a sense, we are traversing uncharted waters. A prolonged spell of large-scale debt monetization is giving way to old-fashioned bond market scrutiny. How treasury supply gets absorbed in this environment is arguably one of the most consequential questions overhanging the investment landscape in the years ahead. All of which underscores the immense long-term costs of today's political dithering on the deficit. It's certainly understandable that politicians up for re-election are loath to champion policies that might entail short-term pain for voters. But in prioritizing their own immediate self-interest over the nation's collective long-term welfare, they are setting us up for a far more turbulent fiscal future than is necessary. The great tragedy is that the remedies for America's budgetary woes are not a mystery. Some combination of entitlement reform, targeted spending restraint and judicious revenue increases could put the nation on a more sustainable path, but it requires a modicum of shared sacrifice and political courage that is in lamentably short supply in this era of zero-sum partisan tribalism. And so the fiscal can gets kicked further down the road, with each punt making the ultimate day of reckoning that much more painful when it arrives. Today's artifice of extraordinary monetary accommodation, papered over many a sin, fiscal and otherwise. Tomorrow's investment world, one where the Fed's largesse can no longer be counted on, will prove far less forgiving. The hope is this looming reality eventually catalyzes a political awakening, spurring our elected representatives to look beyond their next campaign cycle and engage the citizenry in a mature conversation about the difficult fiscal choices ahead. Because if America's budget woes are left to fester out of political expediency, an already precarious long-term outlook for treasuries could darken considerably from here. At stake is more than just some bad quarters for bond fund investors. If global investors were to ever lose faith in America's creditworthiness, it would undermine the very linchpin of the international financial architecture, the dollar's reserve currency status, and with it the myriad economic privileges the nation has long taken for granted, would be jeopardized. Interest rates across the economy would surge as the government's borrowing costs spiked, choking off investment. Living standards would plunge as import prices soared. In such a world, we would look back with nostalgia and yearning for the problems we face today. It is a future none of us should wish to contemplate, but it's one we are slowly drifting towards for each day our political leadership fails to chart a more fiscally responsible course. The numbers, as unyielding as gravity, will have their day. What's required is an outbreak of courage and foresight that seems so painfully elusive in our current national moment. In the meantime, investors are left to grapple with an increasingly enigmatic treasury market, one where traditional verities about haven assets and riskless rates are being stress-tested as never before. The prudent will hope for the best, but increasingly position for something less. Because the storm clouds for the world's most important asset class are gathering, no matter how much we might wish it otherwise. In her cautionary novel Atlas Shrugged, Ayn Rand wrote of a future where society's most productive citizens, weary of shouldering a bloated government's mismanagement, simply walk away and refuse to perpetuate what they know to be unsustainable. One wonders how far we are from a day when the world's savers, fatigued by financing an endless string of deficits from a government unwilling to live within its means, effectively go on strike and decline to pony up at our treasury auctions. The slumbering bond vigilantes may be about to reawaken, and we had best hope our polity awakens with them.